All right. Welcome, everyone, to the live stream. I appreciate you guys joining. I hope you're having a really nice weekend, a really nice Saturday. I'm in Southern California and we're dealing with a big heat wave. So we can't do much outside unless you want to go out into 100 and some odd degree weather. Just got to hunker down and wait this one out. I think in about 3 days it's going to cool off. And I'm looking forward to it because it's been a little too hot. Other than that, it's been a nice weekend. I was able to watch a little football. Football's back. That's great. And was able to look at my investments. I'm licking my wounds just like everybody else. It was a really, really down week. And I will be live streaming tomorrow to kind of talk more about the market and what I'm going to be doing next week. But today, I've gotten a number of comments on videos and live streams from investors really asking for, a little more enablement, like, hey, how do I get started? I mean, this is a pretty big endeavor, right? Investing in stocks. It most definitely is. You don't have to figure it out overnight. You don't have to, become an investor, in 30 days or so. I would say that you could start in a good place and just continue to improve over time, and you're going to do just great. Whether you're in your 20s, 30s, and you're looking at multiple decades of earning income, putting it to work, putting capital to work that you worked hard for, or you're 40, 50, and you're aiming to retire early and you want your money to work a little harder for you so you can make a really good income. I had a moment of frustration probably about 10 years ago. I have been hands-on with my investments, since I earned the money. And I paid somebody who was a professional money manager, and I paid him quite a bit. And it just didn't really bring a lot to the table. I'm not complaining about the expense because I think if somebody brings value, I'm glad to pay them for it. But I think there wasn't a lot of thought behind the investments that person was recommending. And I realized that, well, that person's probably serving 50, if not 75 investors. They can't dedicate, their time to me and really focus on what's important to me and the things that I want to be invested in. But I can. And my background is in accounting, and I got a master's in business, and I've had 3 decades of business experience. So I try to use that in my favor. Now, I'm going to aim today's conversation around, a newer investor into individual stocks. And I'm expecting that most everybody knows about investing. People know that, hey, you can buy ETFs. People have heard of NVIDIA. People have heard of Apple stock. All those fundamentals, I'm expecting that anybody who's tuning into this live stream has it at least that much. But let's talk about individual stocks and how you can, over time, create a good portfolio of individual stocks that are going to perform for you. And that's what the conversation is going to be about. So I kind of set up maybe the first 20, 30 minutes of content just around that topic. And what I hope to do is really just kind of host the conversation around that. So if you're a new investor and you'd like a place where you can, chat your questions, this is the place. You're welcome to ask questions about, certain topics that I bring up, as well as, watching the replay of this live stream or watching videos that could help you become a better investor. So I am streaming on 2 platforms. I'm on YouTube today and I'm on Stocks, and I'm going to try to monitor the chat. And I apologize if I'm a little slow, but it looks like Mike, the dividend investor guy, is on. Awesome to see you on. And yeah, he says, I wish I had what I have now 20 years ago. I wish I had what I have now and still had 20 years left to prepare for retirement. Unfortunately, I'm your age, having kicking into high gear. Cool. Understood. Yeah. I think if you just make your money work better. If anything, it's just going to deliver greater income. And I think it's going to be meaningful based on what you're sharing there. All right. So let's get into it. So where do you start, right? So to begin with, anybody who's really going into investing in individual stocks and wants to do the homework and put in the work and learn and evolve and grow and become just a more valuable person to themselves and to their families, I tip my hat to you. That's commendable. You should feel good about it. It's been something, it's been something that's been important to me since I was a young man, is to really just make my money grow. And it really has happened over a long period of time, but it's really a discipline that is going to take time. So don't feel like you should need to be in a rush, like, especially as you hear these sensational stories like Nvidia is up, 20x and so forth. I think a lot of investors get in trouble because they try to hurry up the returns and they get into really risky investments. The other thing that's out there is there's so much information. There's probably too much information. You're hearing from 500 different sources, what's a good investment. And I would encourage you to be very selective on who you're going to listen to. I am very selective. I don't want to hear from anybody other than there's probably like 6 or 8 people. Some of them are really unknown that have good YouTube videos and good YouTube channels. And some of them are well known. Probably the most recognizable name is Pat Dorsey. If you want to read his book, I would highly recommend it. I have no skin in the game there. I've read his book. It's a very good book. I think it's very applicable to a long-term investor. I'm a long-term investor. I'm not a trader. I might do a trade once in a while, but it's the exception. I'm the type that wants to buy a company and have that company work for me, make money while I sleep over time. And I want a company to double in value every 5 years, if not sooner. That's my investing lane. That's what I do. And that's what everything that I talk about is about, being a more long-term investor. It doesn't mean you buy a stock and own it forever. That's a fallacy, by the way. Even Warren Buffett just sold Paramount. It proves that even the great Warren Buffett will recognize he made a wrong investment and he got out. He sold half his position of Apple. And again, another piece of evidence that some of these, fallacies are kind of, good to listen to and conceptually, but they're not really put into practice. Everybody sells a stock when it goes bad. All right, so let's move on. So why do you want to invest in individual stocks? What's the deal, man? This past week is a good example. Why do I want to expose myself to, looking at my portfolio and seeing a big red number at the end of the week? Why? Because over time, you're going to make more money. It's very simple. The alternatives to stocks is not very attractive. Here's a chart here. And if you were like a super safe investor, hey, I'm just going to invest in fixed income, bonds, CDs, that kind of thing. And I know people like that. I had a mentor in life that was exactly like that. He was a successful person, but he put all his money in CDs, and you're going to make about, on average, 5.3%. And if you've heard of the rule of 72, you divide 72 by your rate of return, and that's how often your money's going to double. At 5.3, he's going to have to wait about 14 to 15 years to double his money. Let's go over to stocks. The average person that's completely into stocks is going to have an average rate of return of 10.3, almost double that of bonds. So that person is going to double their money every 7 years. So if you start with 100 grand, in 7 years, you have 200 grand. In 14, you'll have 14 grand. You'll have 200 grand, and you have 400 grand in 10 years, because you're doubling, you're compounding. And the meantime, you're putting in more capital. So your wealth really expands when you have a greater return, a rate of return. That's why we play with stocks. That's why we spend so much time on stocks. Is in my case, I've been working for 3 decades, and have been fortunate to have a good career. I've invested in real estate. I've had, enough money for my family and enough to put away always. And a rate of return is really important to me because it really creates very good appreciation and income for me. So this is the reason why I put in the time and energy. And I would encourage you to think along those lines is, it's very easy to sit back and say, well, I'll just let somebody else manage my money. And you'll be kind of in the middle somewhere here. And worse yet, let's say you're here at 8.8%. That's fine that you're 8.8%, but you're probably going to pay somebody a 1% fee, maybe a 0.5% fee, and that erodes from your rate of return. When you invest in individual stocks on your own, you're not paying anyone. You are putting in the time and energy to understand your investments, to make good investments, but you're not paying anybody. So you're saving that rate. Once you get into, let's say you save up and over time, over decades, you have $1 million. That 1% begins to be meaningful. That's like $10,000. So that per year for 10 years, it really adds up. So that's why I'm in individual stocks. That's why a lot of investors are in individual stocks. There's no competing investment right now. Bonds don't produce as much appreciation. So stocks are the choice to most investors that want to grow their wealth. Now we're dealing with a really bad week, right? Horrible week. And it's actually good news because we can get to buy the companies we want to own at a lower price, which is great. And hey, Nichix, thanks for joining, man. And I'm going to keep rolling, but thank you for joining. And let me see if anybody else. Okay. If you guys have any questions, please put them in the chat. And if you have any requests on a topic to talk about within this scope, please put it in the chat. We can look at stocks later once I'm done through this talk track. So now what I'm showing you here is how often is the company in the green? Like we had a very good year in 2023. I don't think anybody's complaining. The NASDAQ was up in 37%. The S&P was up 25, 26%. Everybody's happy. But every once in a while, you have a year like 2022, or worse yet, like 2008, 2009. We had the Great Recession. So you have some red years, okay? But they're not, I would say that it's probably 60, 70% of the time we're in the green to some extent. And we do have negative years. We have pullbacks. We have times when, stocks really do sell off. Right now, we're not in a, I think, grave situation where we have a really negative catalyst like we had back in 2007, 2008, 2009. We had the subprime mortgage meltdown, which was really bad for the economy. It just broke a lot of things. It broke insurance companies, all kinds of things. We don't have anything like that. We just have what was an economy that was fueled by a lot of stimulus money a couple of years ago. Companies are slowing down their growth. They're laying people off. I think it's going to be a mild recession that we deal with. So and that's why the stock market is selling off. As it sells off, it presents opportunities. So to show a couple of examples, I'm going to drill into Amazon and show you the rate of return over a long period of time, Uber, and then United Therapeutics. You definitely have heard of Amazon, right? For all I know, everybody got something delivered from Amazon. I had multiple things delivered yesterday. I don't know if anything's coming today. And then Uber, right? The ride-hailing company, and then United Therapeutics. So we're going from gigantic. This is a almost $2 trillion, if not $2 trillion company. Uber is smaller than 100 billion, but it's a growth company. Then United Therapeutics is small, and they're in call them a biotech company, just to show how these companies are doing, because the companies are out there to find and really begin to invest in and really get this rate of return. So the advantages of going into an Amazon is it's easy to understand a company like Amazon. We know that. Um, cool. Hey, Ian, thanks for tuning in. And I appreciate you tuning in for a little bit and then listening later. I appreciate it. Thanks for tuning in. So Amazon, it's easy to get your head around it. And we know that they grew so much, right? And their stock has just been a really good investment for investors. And I've participated in the stock and I own shares now. I'm building a position back again because I bought at the right time, had a really good gain, and then I sold and I regretted it. So I'm rebuying. But you could see that, again, going back to why do we invest in stocks is so that you can find an Amazon. So you can buy it when it's sold off and you can have a nice 125% return over the course of a year. If you put 100,000 into it, you just made $124,000. That's why we look for stocks that are really valuable. And we do our homework and we put in the time and we learn over years, decades, is so that we can be in a position to take advantage of that. Now, Amazon's an obvious company that's super valuable. One that's a little less obvious, but very well known is Uber. And Uber is showing very good returns. If you look at Uber, where it was priced in 22 to where it's priced now, 226% rate of return for 2 years. I'll take that. I'll take that and then some. I'm a big Uber shareholder. Very happy with where they're going with their business. They have an exciting future. But this one was hiding in plain sight for everybody to invest in. And now that we're having this big pullback, it may be an opportunity to buy some of these companies that are really, really valuable. But we got to do the homework. We got to buy at the right times. Mike, the dividend investor guy, he's like me, I'm like him. He does a lot of homework and he waits for the company to be priced so that he feels like it's a good investment. It's the right approach. Wait for it to be discounted to a point where you feel like you're going to buy in and have a very good return. So that's Uber. That's hiding in plain sight. Now, one that's a little harder to find is, a smaller company. United Therapeutics is a biotech company. And if you look at this company, what they do, it's pretty amazing what they do. And the great thing about it is they're helping people with illnesses and conditions they have, so they have a better quality of life as a result. I mean, everybody wins. The patient wins, United Therapeutics wins, and look at their rate of return. Just a beautiful upward chart. They've gone up 300% over the last 4.5 years. I've been an investor probably for about 1.5 years, so I'm doing really well with the stock, and I think there's just really good upside. These are examples of companies that are out there, and finding them is really, this is the end point, is finding good companies like this. Now let me talk about how we get to that end point, right? So there's too much information, it seems. I mean, look at this list. These are just the top companies. So if you're an individual investor, you have just websites and YouTube channels, and you got information coming at you from 100 different directions. So a couple of things, words of wisdom that I would bestow upon you is understand, what investor you want to be. Do you want to devote an hour a week, 10 hours a week? Do you want to look at it monthly, annually? The thing that I would discourage you from doing is you kind of do it for 2 weeks and then forget about it and go away. That could be a big losing proposition, because you may make some decisions that weren't the greatest and they're in your portfolio and they stay there for a couple of years. But whatever time you can invest in it, define what level of investment of time you can put into it. And then look for like-minded investors online. I mean, there's so many good investors that have YouTube channels. I stay away from the ones that promise, they promise me to get super wealthy overnight. Right. I don't believe any of that, but maybe they do, and I've been doing it wrong. But all kidding aside, I really look for like-minded investors that really have a discipline to their approach, that do a lot of analysis. I learn from them. And as you guys have seen on my videos and live streams, I really get into the financials. I analyze the company, and I have a process, which I'm going to talk about later. So you define the type of investor that you want to be, and what is it you're trying to accomplish? Is it you want to just retire, in 5 years, 10 years, 20 years, 50 years? Do you want to buy a house? Those things. It's important to define that, so that way you have that North Star to really be motivated and really try to achieve it, because it's really meaningful. Maybe you want to put a child through college, right? I'm put two I put an older boy through college, and he's a great kid. Glad to have done so. And then his younger brother is a junior in college, and my boys, their college tuition's completely paid because of stock investing and real estate investing. So that's the kind of freedom and empowerment that you get from being a really good investor. So once you put meaning behind the outcome, I think it becomes really motivating. So define the type of investor you want to be. Do you want to be an investor, a long-term investor? Do you want to be a trader? Hey, that's cool. Traders make money, and there's lots of, really good, talented people that you can interact with and be that type of investor. I'm a longer-term investor. I like to find quality companies and stick to them for a while. So you've decided this is how much time I can put into it. This is the type of investor I want to be. The next thing is, I would encourage you to think about all the different jobs you've had, the education you have, and lighten up with the industries that exist out there. So there's all these industries, right? So there's 11 sectors, all companies, thousands of companies get matched up with these 11 sectors. And sectors like healthcare, that have pharmaceutical companies, has healthcare insurance payers, things like that. Of course, you have technology that has software companies, semiconductors like NVIDIA, Apple, hardware company. So get a good understanding of all the jobs you've had, and you feel like, hey, I understand an industry. Let's say I worked at a social network company, so I understand social networks. So I would probably understand Meta quite well, or Google, or a like company, because I had that experience. Or maybe you worked at a different industry where you have that understanding. That's an advantage you have. And it also will make it more intuitive for you to understand those companies when you break open their financials, when you study their websites, when you look at their earnings calls. That's going to be an easier company for you to understand because you worked in that industry. So I would, if you're getting started, or even if you are an established investor, continue to think about what industries have you worked in, and where do you have a knowledge advantage, an awareness advantage, an experience advantage. Because not all investors have worked in all industries. You may have a couple of industries that you become really good at. So keep that in mind, that, hey, determine the investor you're going to be, and then determine, okay, where's a good starting point? Well, let me start in things that I already know. You worked at a particular industry. I would say start researching companies in that industry, because you probably have that knowledge advantage. So when you read Peter Lynch's book, One Up on Wall Street, he was a big advocate of that. And I like the Peter Lynch story because Peter Lynch ended up being one of the best mutual fund managers. That's what we called them before. We called them hedge fund managers. In the 80s and going into the 90s, he was still really good. But he was the best. He was Michael Jordan of his time. He didn't have a finance background. He came from outside of finance, worked at Fidelity, and thought, hey, I think I could do that. And his thought process was he was going to use the things that made sense to him, the things that he understood, and kind of follow those threads and really understand those companies and try to find companies that were really good that were undiscovered, because everybody else is doing a stock screener where he was kind of just drilling into places that he already knew really well. So he knew things that, certain trends, whether a trend was going to be valuable or not. And his book is excellent too, but Peter Lynch's book is kind of dated. He operated in the 80s, early 90s. I don't know how old he is now, but he's a little dated. I think his book's great. Pat Dorsey, on the other hand, he has great process. He's the real deal. I really like his process. I really like his book. So that would be another thing that I would say is read some books, understand, what type of investor you want to be, and then start, learning it, start trying to do it. Looks like I've got some comments here. So Osama is asking, please go through when it is best time to enter and exit the market. So glad to answer that question, but I'm going to answer it this way, which is the best time to enter a stock, buy a stock, and then the best time to exit a stock, sell the stock. So the best time to enter a stock is you have, like I just started buying into Qualcomm. Qualcomm is a stock that I just started buying into. I think it's discounted by 31%. And if you follow the Qualcomm stock, I'm going to answer your question with a specific example. And in this example, the reason I can answer your question completely is that I sold Qualcomm about here. I bought it around here, and I dollar cost averaged my investment. So the investment went up really nicely. A dollar cost average, so I didn't do 107%, but I did really well. And then I felt like the whole AI space was completely overpriced. My valuation of the company based on the intrinsic value of Qualcomm was far lower than that. And I'll, for the sake of time, I'm not going to show that. So I felt that Qualcomm was priced far lower than where it was going. So my exit strategy, my entry point was Qualcomm is discounted. So I bought. My exit price was way up here and I sold. And sometimes the stocks keep going, but in this case here, it ended up kind of agreeing with my analysis. Now Qualcomm is down with the rest of the semiconductors to the point where it's discounted. So now I'm buying Qualcomm again. So the answer to your question is, it's not about entering the market and exiting the market. That's not the kind of investor I am. It's not like I buy the S&P and sell the S&P. I used to do that when I was really busy with my career and family, because my kids are no longer little. They're adults. But when they were little, I wanted to spend a lot of time with them. So I was putting my money in mutual funds and so forth and ETFs. But now I really think about stocks, and a stock belongs to an industry. That industry belongs to a sector. And getting in and out is going to be a decision that you make. Okay, that company is about to do really well because that industry is about to do really well. There's a certain catalyst that's going to help that industry. So it's a good idea to enter that position, that investment, and understand, are you dealing with a cyclical industry that's good for 2-3 years? And then I should plan on selling maybe when I achieve a certain return, or maybe when I see that bad news is beginning to hit. So you would get out. Another stock I own is Zim. I've already defined that I bought Zim roughly at $10 and I've dollar cost average since then. And I'm aiming to sell it at 30. So I've already got my exit price. So Osama, on some stocks, it's easy. I want to get in below this price, and then I want to sell once I've attained this type of return. If the stock does not value, if the stock is priced much higher than the intrinsic value that I calculated. There's a few exceptions, which is the cream of the crop companies, high quality companies like an Amazon. I followed that logic I just explained and I regretted it, because the highest quality companies will always continue to expand their value, and their control of their markets is so strong that over time, they just achieve really good returns. So it's kind of a long-winded answer, but I think as you invest more and you become more aware, that your question would probably be more focused. How do I enter and exit when I'm investing in healthcare? And then you can precisely say, hey, within a healthcare pharmaceutical company, I want to invest when nobody likes the company. Maybe they had a bad year, but I see their catalog of pharmaceuticals that are still on patent is really strong and it's about to really take off. I want to get in early and then reap the reward of staying in that stock for 3-4 years, continue to reassess and reanalyze the company every quarter. Thanks for the question. It's a very good question. Graham Construction. I've been watching your videos, learning a lot. How do you dollar cost average? Very good question. All right. So on Qualcomm, I did a couple of things on Qualcomm, and I can answer your question with a real life example. So I hope I can answer your question with a real life example. Oh, no, it was a different file. So what I did was I ended up buying Qualcomm. And I just got a new computer, guys, like yesterday. So I'm a little new to it, but I'm going to be able to explain this way. So when I bought Qualcomm, I started off with $1,000 purchase of stock. And what I try to do is I try to find a zone where a stock is discounted, right? I do my analysis and I say, I believe Qualcomm is worth $206 per share based on their free cash flows that I have. And you've seen my videos, so you see me go through here. And you know that cash, it's kind of like having a CD. If your bank said, hey, Graham, I'm going to give you, they're not going to give you 10 billion, but let's just keep it down. Like, we're going to give you $10,000 year one, $11,000 year two, $12,000 year three. You can begin to give it a net present value because you can discount the future cash flows. As I look at their financials, try to determine a accurate forecast of the cash flows and discount it. Based on those cash flows and based on their earnings per share, I get to a value per share. So now I've got information that's actionable. So now I wait for the stock to come below $206 per share at a significant level. It's not like, oh, it's 1% below. No, it's not enough. And you see this trend, it's coming down. Okay. Now, when you look at Qualcomm, it's part of semiconductor. And semiconductor, of course, has NVIDIA, which was down 13% last week. It's also part of Broadcom's industry, and it was down 15% last week. Oh, man. Pain in the semiconductor industry. So when you look at these stocks, they're all coming down because the whole industry has been on a downturn. Well, lower stock prices, it's bad news if you're a stockholder. It's great news if you're a stock investor and you're sitting there, kind of like Mike. He's been sharing with me as we collaborate on Discord. He's like fishing for big fish. He's fishing for a beautiful marlin, and he knows where to set the bait. The bait is we're looking for quality companies that come down in price. If you look at Qualcomm's business, it's growing. It's going up in revenue. Meanwhile, the stock market is discounting a growing business that is very profitable, generates cash flow. Thank you, stock market. So I buy $1,000 to get started, and then I buy on pullback days. Let's say I buy $1,000, it goes up, it's in the green, I don't buy. It comes down 1%. I might buy $300. I might buy $500. If I'm in a hurry to buy a stock like Amazon, I bought $3,000 of it on Friday. I think I bought at least $1,000 each day last week on Amazon. And on one day, I bought $2,000. On Friday, I bought $3,000 because I'm on an accelerated buy plan with Amazon. That's the exception. Most other stocks like Qualcomm, I think to myself, I theorize, I'd be comfortable owning $50,000 of Qualcomm because I know Qualcomm. I know that they are a quality company. They've been in business for a long time. They're in California where I live, and they're very well known. And they are cyclical. It's a cyclical industry, but you look at how big they are. They're a very well established brand. They also have a little bit of defense orientation, which is a lot of their technologies go to the Defense Department, which is nice because that is really good during recessions because the Defense Department is going to have a strong army whether we're in recession or we're in a boom cycle. So that answers your question of how a dollar cost average. I keep it simple. And I like my broker, one of the tough things is some stocks trade for like $1,000 a share and some trade for $25 a share. So I just like doing dollars, hey, I could cleanly say $300. I'm going to put $300 increments on that dollar cost averaging. And over time, I'll build up a, $50,000 position. The reason I dollar cost averages, I am not smart enough, lucky enough to tell you when exactly a stock is going to be at its lowest point. Nobody is. So I couldn't tell you, oh yeah, on May 12th, 2023 is when I'm going to buy $50,000 because that's going to be the low point. Anybody that can do that is making it up. It's impossible. Even Warren Buffett will tell you that's impossible. But I do recognize in this zone, I feel the company is discounted. So I'm going to dollar cost average. And in most cases, it works for me. In some cases, I lose money. I don't have to make money on every single stock. I just have to cut bait on the losers and realize it soon. I analyze companies at least twice a quarter. That's like every month and a half, especially on their earnings. And I want to make sure that their business is still operating in the direction with the quality that I thought they had going forward. If that's the case, I keep putting money into it. But I do my homework on the company and a dollar cost average. Very good question. You guys are bringing good questions to the table. Thank you. So Nichix, when you start reviewing stocks, please take a look at Fomento Económico. Yeah, you got it. I think is that the beverage company? I think it is. And that's FMX. I think it is. I looked at them. I was looking at stocks in Mexico. We'll get there a little later. I'll tell you my whole story of how I analyze stocks in Mexico. All right. So you're a new investor. All right. So maybe you're a year into it, 5 years into it. You're like, okay, I kind of know the amount of time I can devote to it. I can devote 5 hours a week, 5 hours a month, 20 hours a month, however it is. And I hope that investing draws you in. I encourage you to put the outcomes, like an outcome would be, hey, I made $300,000 collectively from appreciation, dividends of my investments. 300 grand. That's more money than I need to live on. That's enough money for me to put more money away. That's enough money to take my wife to Italy, which I did last year. That's the outcome has a connection to things that are going to be really fun and really meaningful to me, like my boys and my sons and my wife, the people that I care about. And it really has drawn me in because I feel like I've figured out a few things and it's very rewarding. It's very satisfying to make a good investment. I used to play sports. I played baseball and I played football. And I also did quite a bit of bicycle racing and mountain biking. And something that was really satisfying was hitting a baseball. It's really hard to do. But when you hit a ball just perfectly, it just feels so good. It feels like you just swung perfectly and everything comes into alignment. Well, that's great, but I look at my Meta stock and I'm like, forget baseball. I love my rate of return on Meta. Or I had a little company by the name of Panel, and I 6x'd my money, 7x'd my money. I took like 10, 15 grand and grew it to like 70 grand. That's so fun, so satisfying to nail an investment. And now I don't play any competitive sports. I really, I'm not, I love hiking. I love being outdoors. I love hanging out with my family. But my game now is stock investing, real estate investing, investing in bonds, investing a little bit in cryptos because it's so freaking fun. It's drawn me in. I really enjoy it. I enjoy having advantages that come with, the hard work of understanding a company, understanding it before other investors do, getting in early. All that is super fun. Okay. So, I was talking about the new investor, and I know that it could be super intimidating, that there's so much information. I'm probably going to make mistakes and so forth. And yeah, you probably are going to have a couple of losing stocks, but be aware. I think I showed the graph that not all years are going to be green. Not all investments are guaranteed to go up in value. Some of them are going to be red. You don't have to have a perfect record to win the Super Bowl. You don't have to have a perfect record to make a lot of money. You just have to have a winning record. Pick better companies. If you pick 7 out of 10 companies that are good companies, are going to grow, are going to appreciate for you, you're going to be fine. And you have to have a process that identifies the bad 3 and try to limit your exposure and get rid of them at some point. And then you continually, it's kind of like gardening where, weeds and all kinds of pests and stuff are always attacking your garden. You have to tend to that garden to keep it really, really strong. All right. So just a couple other things that I had noted that I wanted to pass along. So we talked about, the satisfaction of finding the right stocks. One of the things that ETFs didn't give me was being an ETF owner is like, really having a distant relationship from the equities. You kind of buy an ETF, the fund manager buys 50, if not 100 different companies, and they buy like 2% of this, 1% of that. You really aren't investing in any one company. So you're not really connected to those companies. It doesn't really mean much. So individual stocks give you a different perspective, and I think a funner perspective. There's a lot of information out there, but once you find like-minded investors, no matter what your age, try to pick somebody or a couple resources that they have more experience than you. They're very successful at what they do. And it's not like, for me, I don't care about flashy. Like Warren Buffett goes to McDonald's and uses coupons. It's like, I love the guy. And that guy's got more money than his family is going to know what to do with. But I'm talking about like I've been listening to Josh Brown. I don't agree with Josh Brown in a lot of ways, but I can tell you that guy is really smart, and he constantly says things that I really appreciate and I really get a lot out of, especially his observation of the market. Jim Cramer, ditto. I don't really listen to much of like direction of investments with Jim Cramer, but his understanding of market sentiment is one of the best. So I look for other investors that are better than me, where I can borrow their knowledge, their experience, and I listen to them so I could, weed out or bring out like the substance that I'm looking for, not necessarily listening to the whole like message that they say. So keep that in mind as you go out there. And what's awesome about now, we're in the golden age of investing. You can go on YouTube and search for anything. You're watching me, and I bet you a bunch of you guys are all over the world. So that's awesome. It's the golden age, man. We got information flowing freely. Knowledge is going from one investor to the next. When I was a young man, the one thing that I did that I thought was a good idea was I got mentors. And early on, I sought out people that I thought, that's the industry I want to be in. I made a connection. I asked them if, I didn't ask them. I just kind of started calling them and established a relationship. And they were awesome. They taught me so much, and a lot of them taught me about stocks. That mentorship is out there in your community, and seek out somebody that's already a stock investor. Not necessarily where they're going to say, oh yeah, give me 100 grand and I'll invest it for you. No, but see if somebody's successful in your community, see if they can give you, if anything, some advice, general advice, because that general advice was really useful to me. And then I can go work the details out. I'm really good with math, and I could build models. I can do all that stuff. So keep that in mind, that your community probably has a lot of mentors. And it doesn't matter your age, by the way. I got mentors that are way younger than I am. I got mentors that are way older, especially around crypto, right? It's so darn new, man. Every time I have a question, I have to go ask somebody that's younger than I am. Okay, so you got all this access to information. We got these awesome companies. Like, we're going to look at this FMX company. Here's the next thing that I really believe in is process. If you guys that have been watching my videos probably understand that I look at a couple of things and I go deep. First, I want to be a believer in the company. I want to look at a company and I want to be able to say, this company is very desirable. It's okay. It's somewhat desirable. So it's very desirable. It's somewhat desirable. It's in the gray, or it's undesirable. So an example of a very desirable company would be Microsoft. Microsoft has been a growing company for a long time. They generate very high cash flows. They're a very powerful company within their industry. They probably are the monopoly of desktop applications for the PC. It's an example of a very desirable company, a monopoly-like growth, high cash flows, very valuable. An example of a company that's, it's okay, it's a pretty good company, would be a company like 3M. I'm a stockholder of 3M. It's a very good quality company. They're just not like super powerful and a monopoly-like company. They're a good company at the right price, good investment. And then there's undesirable companies. These are companies that have too much competition. They don't make a lot of money. If anything, they're always losing money. They don't make any free cash flow. So my first step in my process is I have to buy into the company. I have to understand where they fit on this quadrant. Do I think they're a great company like a Microsoft? Do I think they're more like a 3M? Is it an industry I want to be in? Like, I hate utilities. I don't hate utilities. I just don't invest in them. That's an example of an industry that I do not touch. I think utilities are squarely in the red. They're always putting too much capital back into their business. So step one is company. Step two is balance sheet. The balance sheet is often never covered by like the big, like if you look at Qualcomm and you look at where the analysts are talking about it, they're purely talking about earnings per share. And they're talking about earnings per share. They're saying it's discounted by 29.7%. I'm saying it's discounted by 31%. So I guess we agree there. So they strictly look at earnings per share, which I understand. This is the easiest valuation method to get to a stock value. But something that's really important is the balance sheet. If a company has too much debt, they're going to be in a lot of trouble. AT&T has a very lucrative business, but they have too much debt. So their business is always struggling to pay that stupid debt, all the interest payments. So you want to have debt less than 3 times EBITDA. So company balance sheet based on 3 times EBITDA, and now discount. And the discount, I've created this model. I created it by learning from others and then having a spreadsheet model that I know inside and out. I've created every field, every calculation. It's based on financial terms, but this is my toolbox. This is my general tool. If I was a plumber, and I shouldn't have used that analogy because I don't know what tools they use. If I was a carpenter, this is my circular saw, my hammer, that part of my toolbox. This is what I would have as a carpenter. I'm a stock investor. I want to see their cash flows. This is 66% of the value of the company for me. And then 1/3 is earnings per share. So company, quality of the balance sheet, discount. And then I make a decision to buy, pass, or if I'm an owner and next thing you know, the company's priced way too high, potentially sell. My process has really 3 areas of analysis that are very specific, and then 1 decision. So process, you need to determine your process. Don't look at like 500 metrics. That's too much information. You got to have a process you're comfortable with that you can learn from. Hey, that investment went right. Why did I get it right? That investment went wrong. Why did I get it wrong? And as you analyze a company every quarter, you are looking through their financials with your lens. You're picking out the things that are important to you. And you're going to keep getting better as you scrub through financials, scrubbing through them, getting to know the business. You get to know the company by understanding their products, understanding how they fit in their industry. And high level, you're like, okay, they're a really good company. Like Uber as an example, it's a leading company, right? It's a leading company in ride sharing. So it's kind of easy for us to get our heads around that. Other businesses are harder because like I've been asked about uranium companies and companies that are way outside my domain. So I always tell people that I'm, answering the question is, well, that's not my domain, but I'm going to answer the question, which is let's look at their fundamentals. I would have to get up to speed on like uranium and all that stuff. So company, balance sheet, discount, make a decision. That's my process. I keep it as simple as possible. This is so hard already that if I can keep it simple, I'm going to be more successful. I encourage you to really start defining your process. And don't copy my process. You can use it as an example. You can kind of say, hey, that kind of makes sense to me. But you need to make it your process. You need to know every step of the way has to be your step. And you'll become better because it's yours. And next thing you know, you wake up 10 years from now and you're making great investments. You're like, great, making lots of money each year. Even on down years, I had a very productive year. 2022 was very productive for me. The dollars were in the negative, but I bought a ton of Meta. I bought a ton of like stocks that just crushed it in 23. So there you have it. I'm seeing some old friends. Bad Omen, good to see you, buddy. Can you look at BYDD? Absolutely. Let me note that. I hadn't been on YouTube because I was focusing on stocks, and but now I'm back on both, and it's good to see some old friends, man. I've been hanging with you guys for a while, and it's great to see you. Michael Anthony, Oxy. Yeah, man, let's look at Oxy. I haven't seen Oxy in a while, and oil has just been in the oil winter, man. Oil prices are down. So let's take a look at that one. And it says Oxy hit a new low on Friday. Tech going much lower than Kramer say we're going into recession on his show Thursday. Friday, Tom Lee is going lower. Yeah, so I'm thinking if I'm almost near the end of my talk track, then I'm going to come back to your comment because I want to talk about Tom Lee and I want to talk about Jim Cramer. But I like your comment. Thanks for putting it out there. So, all right. So process. And your process, you don't have to nail it like day one. Just have a process and refine it over time. My process has been refined over time. And I've tried to make it simple. I really encourage you to make it simple. We already know that investing, when you look at a company, back to Qualcomm, and you go through the financials, and these guys simplify their financials. You're looking at how many lines, right? And you're looking at multiple years. You're looking at income statement. You're looking at revenues. You're looking at quarterly information. You're taking a very big data set and you're trying to pick out here are the things. It's like being a doctor in the emergency room and the patient comes in. There could be 1,000 things going on with that person. So they ask a couple key questions so they can then hone in. What's my right treatment for this person to help them? In a similar way, we try to look for the data that if it fits our model, we continue to invest our time. If it continues to fit our model, we continue to invest our time. And at some point, we invest our money, our capital, but it's after good analysis. And if you have a simple process, and a very well thought out valuation method, you're going to be more successful, because simple means you're going to realize what went right and what went wrong. Simple means you understand it. So that's one thing that I really wanted to hit home on, is simplicity in your process and making sure you have a process. Document it, put it in a spreadsheet, put it in a Word document, put it in a whatever. And you use that document, use that spreadsheet when you evaluate companies. And you go through it pretty much like a checklist, like a pilot when they check the plane when they're going to take off. It's a checklist. And you know why it's a checklist? Because they don't want something to go wrong. Because in the middle of flights, you don't want to crash. It's a really bad thing when you crash. So they want to check all these things that are really important. And they have a checklist. Keep your processes that like checklist so you can make a good investment. If you have an investment that goes bad, like you start losing money, you're like, okay, what did I get wrong? You know, like what in my decision process did I underestimate, overestimate, think was going to go one way, but it went another? It's clearer if you have a simple process. Last step is, so you've gone through a complete cycle. You're like, okay, I did my homework. I got my process. I invested in one company. Start measuring performance. Okay. And measure that performance just so that you can keep an eye on, you know, how are you doing monthly, quarterly. It's pretty easy, right? You get a statement from your brokerage every month. It's very easy to sit down and say, okay, what happened? And try to understand the market. Like this past week was horrible. The Friday and Saturday before the week started, I created a video that was like, hey, are we going to have a September correction, right? I wasn't like hoping it happened. It's just Septembers are this way. Octobers are similar too. So I was just kind of telegraphing to the community that I'm a part of is, hey, everybody, you know, put on your chin strap, because we may have a tough month for multiple reasons. So I felt like I was doing a service to the community I'm a part of by sharing that video. And I'm glad that it had some accuracy to it. It definitely had a lot of accuracy to it. I'm shorting some stocks around semiconductor. I started shorting them 3 months ago. Now they're really tanking. There's a level of, satisfaction, and, it's like hitting that baseball. Man, I really hit that baseball really well on those shorts with NVIDIA and Broadcom. I already closed out my position on Supermicro. I closed out my position on CrowdStrike. So that kind of stuff is, you measure performance. You measure performance to see if you're getting better. Measure performance, and you think you're good at a particular industry. This has happened to me. I think I understand an industry, and I invest in it, and I lose my shirt, and I'm like, the heck with that. I'm not going to invest in that industry anymore unless I really get better or it's clearer to me. But I've kind of sworn off like retail, expensive retail. It's like, yeah, it's not my thing. I stay out of certain industries because I kind of learned a few lessons along the years, and I'm like, okay, I measure performance, and I want to make sure I don't repeat things that are costing me a lot of money. I want to repeat things that are making me a lot of money. That's very clear. So that's my advice. I know that I threw a lot at you as a new investor, but what I wanted to do is kind of start the conversation around, if you're a new investor, you're welcome. You can ask questions. Don't be intimidated. If you have the courage to ask questions, awesome. I mean, you can just write them in here and then you'll be good to go. Because 30 years ago, when I was kind of getting going, all the people that I asked, hey, can you lend me your advice? What about this? What about that? They'd always like make time and do me a solid. And I want to do the same for new investors. So Michael Anthony had a question around Tom Lee and Jim Cramer. So Tom Lee, if you recall, so again, listen to people that are very good and so this is Tom Lee. He's a brilliant investor. The one thing I would say that I I kind of filter what Tom Lee has said for a long time is he was always a bull. Like, oh man, you know, growth stocks are just going to do phenomenal and small caps are going to do great. And in a way, he was right. I believe at the beginning of 24, he was dead on. A lot of people were like pessimistic. He nailed it. He nailed the economic data that did come out. So he came out last week and he was very concerned. He was very concerned about growth stocks. So when a perma bull is what they labeled them, he was always like, hey, it's going to be great. Companies are going to grow. They're going to make lots of money. All of a sudden goes, uh-oh, companies are going to really struggle to grow. It's going to be hard on the market. I think we're going to have a brutal next 12 months. When Tom Lee says that, holy smokes, man. Put on your chin strap because this is going to be a contact sport. So that's what I got out of Tom Lee's message this week. I think Tom Lee is a brilliant guy. You listen to him. Again, I listen to a lot of these brilliant people. There's a lot of things Tom Lee does that I'm like, yeah, that's not my gig. That's not my bag. But I get what you're saying. And in certain cases like this week, when he talks about the economy, that we're going into recession, that growth companies are going to have a hard time, I was like, I agree with him. And he's a respected voice. So that's why I listen to this guy. Jim Cramer is the same. Jim Cramer, I know that, you got to listen. I understand Jim Cramer, and he's a TV personality, and he has a very close relationship with CEOs. So he tends to be accommodating and complimentary to a lot of companies, and he tends to pump a lot of stocks. That's what I don't like about Jim Cramer. But his comments on economy and market sentiment are really good. And his comments are coming in concerning. He's gone as far as saying that NVIDIA is overpriced. And a year ago, he was like NVIDIA's biggest cheerleader. So really good comments there. I'm glad you're listening to those guys, because those guys will give you a sense of, is the market going to go down? Is it going to go up? Is it a great time? Is it going to be a boom cycle? They kind of give you a little bit of that sentiment. So that's why I listen to them. Have you bought anything this week? And any food companies been going up? Okay. So I bought a lot of shares this week. The market was down a lot. The stock that I bought most of is Amazon, and they do sell food, by the way. They have Whole Foods, and they also have a new retail concept, which is not a Whole Foods. It's called Prime something. My wife goes there. So I bought a lot of Amazon, and I bought my usual suspects, like Uber, Meta. I bought a lot of Google. I think Google's being discounted really well. I bought healthcare when I could, although healthcare did keep its value fairly well this week. So that was good to see. And on Discord, I usually kind of copy and paste, what I'm buying actively. So I can't think off the top of my head all the stocks. Let me go down my list of stocks so I can tell you which ones I bought the most of. So I bought a lot of Amazon, a lot of Alphabet, Google, a lot of Amazon. I already said that. Sorry. I'm holding on Starbucks, Airbnb. I'm not buying anymore, but I'm holding my shares. I'm holding my CVX. I'm holding my Coinbase, and it's getting. Actually, I bought a few shares of Coinbase because it got just so destroyed this past week. I'm buying PayPal. PayPal's starting to work, so I bought PayPal this week. Holding on Citigroup. It's good investment, but I'm just holding. Bought Catalyst. I bought United Therapeutics. I bought a little bit of Pfizer. Pfizer held its value well. Elevance really held its value well this week, all things considered. It was down one day, and I bought some then. Didn't buy any 3M. I'm doing good on 3M. And right now, like 3M's a good example. I'm up 66%, but there's really no discount left on 3M. So I'm just holding, and actually I'm up 46%, excuse me. So I'm just holding on 3M. It's got a really good rate of return because I bought it roughly a year ago. So I'm good on 3M. Still operating really well. Zim, I bought more Zim shares. Uber, I bought a few shares, but not a whole lot. I'm holding on my Ternium, but not buying any more shares. I bought more Cisco. I'm holding on Hewlett Packard. I'm shorting Apple. I think Apple doesn't have a very good strategy. I told you that I bought Qualcomm. I bought a little over $1,000 of Qualcomm, and that was a buy that I made on Friday. So I'm shorting Broadcom. I'm shorting NVIDIA. I bought a little bit of Adobe, although Adobe just has a small discount, but it's a high-quality company. I bought more DocuSign, and I bought it the day before I went up 4%. DocuSign stood up tall, up 4% on Friday when everything else was tanking. I'm holding on Zoom, and those are my positions. So I just gave you a quick flyby there. Why no interest in Palantir? I've valued Palantir, and what's their current stock price? And every time I look at it, I think they're being priced at a premium. So Palantir, a good friend of mine owns Palantir, and he bought it at the right time. But I just don't believe in the company, or at least the discount. So your stock price is $30.33. Yeah, so $30.33. So I think the stock's being priced at a premium of 45%. So that's why I don't buy Palantir. I think they're in an interesting business. They've been a high growth company, but they're in a space where the bigger software companies are going to come knocking on their door, competing against them at some point. And they're being priced well above their intrinsic value based on free cash flows and earnings per share, because the earnings per share is based on a really high multiple that I don't believe in. I use my own multiple. It's my capital. It's my multiple. But thanks for asking. Hopefully you find my comment interesting. For all I know, Palantir goes up 100%, but I'm just going to give you my my comments on it as I see it. So thanks for the question. Yeah. If we have a downturn, a lot of stocks are going to start looking really good. Like, oh my God, I can't believe this stock's this low and that stock. So that's why, like listening to Tom Lee and understanding sentiment, where's the market going, and trying to understand it so that, with a month's notice or a couple months notice, maybe, speaking for myself, I'm like, okay, I can generate more cash by doing this, maybe doing that, bringing a little more cash into my portfolio. Selling stocks right now is kind of hard because they're going down. So you don't want to sell into a downtrend. But I've been trying to get a little more cash in there. I have a nice bond portfolio, and as those bonds redeem, I'm not buying more bonds very quickly. I'm letting that money go into equities because equities are being discounted till the end. The same thing could be said about Google competition for search and stuff. Yeah. But I think you're comparing to Palantir versus Google. And yeah, if that's the case, I think Google's pretty strong with search and YouTube. I mean, you guys are on YouTube now. It's the number one streaming platform now on Earth. All right. Can you take a look at Corporación América Airports, CAA? Okay. So I got through the kind of stuff that I want to talk about. Now let's talk about these stocks. So we looked at Palantir, but that's CAAP. Okay, so the first one is FMX. And these guys are the Coca-Cola bottler down in Mexico. And man, they drink Coca-Cola down in Mexico, man. They drink a lot of it. Per capita, they're doing really well. And I'm going to get to your question, Graham. Let me finish my thought here because I do have a response to that. So these guys do Coca-Cola, market cap of $31.7 billion. What have they done recently? Let's see, FMX. So it's down 5%. It's got, see, over 5 years, it's done 9%. It probably has a dividend, right? I'll look at it later. So it hasn't been like a superstar company, although for a little while it was, going up. I think when I looked at it, it was doing this. Very nice return if you bought at the right time, right? Found it when it was discounted, bought it in the right zone, dollar cost average, and watched it go up. But now we're seeing that the stock's down 27, almost 28% since February 2nd. So let's take a look at their fundamentals. So 31 billion is their market cap. Their revenue quarterly, let's see here. So revenue growth looks good. Those are good numbers. Very high teens. And then, yeah, the revenue looks good. Okay. So revenue looks good. I like looking at revenue. It tells me that customers are buying more product. More customers are signing up to buy their product. So that's good. Okay. Free cash flow, 26 billion in the trailing 12 months and 14 billion there. So their free cash flow looks good. Let me check something. Is this in pesos or is this in dollars? This is in pesos. Okay. So one peso is 0.05. So when we look at their free cash flow, we see 26,231. That is going to be that's going to be 1.3 billion. And the trailing 12 months, and it was kind of a high watermark. They're a good growing business. So even if I multiplied that times 20, I'd get to about 26. So if I take 1.3 times 20, because they're a growing business, I get to 26 billion. It's still being priced at a premium. And a company that's outside the US for me, I'm going to want a higher rate of return. When you look at this spreadsheet here, see like Palantir, I believe is a risky business. I discounted by 10%. DocuSign is less risky because they have fewer competitors, better known. They have a lower discount rate. The company we just saw is going to have about a 10 because it's outside the US. It's greater risk for me, so I want a greater return. So this one here doesn't look great to me. I think it's overpriced, and I don't know that it's going to have a great return. I mean, over 5 years, if you bought it way back when, it really went down. So if you bought it at the right place, the right times, you would have made a good return. But I think right now it just doesn't show me enough potential over the next 5 years. So I'd have to pass on this one. All right, next one is BYDDY. BYDDY. So BYD company. So these guys are the Chinese car company, right? Okay. Wow. Number of employees, 703,000. Wow. They're a $7.8 billion company. So revenue. The PE is pretty reasonable. And then their growth rate, really good growth. I think they're growing faster than Tesla, most definitely. Free cash flow is, I'm looking at the right statement. No, I'm not. So free cash flow. So they had negative cash flow there, but they had 47.6. And what is this? CNY. This is like 0.17, I believe. .14. So see the cash flow here, it went up and then it came down. They probably put a lot of capital back into their production lines. But if we took 47,632, so they're doing the best year they had was at 6,668,000,000. So if I took 6 billion high growth times 30, I get to 180 billion. But they're in China. So, the reality is, so there's two things that are showstoppers for me. So BYD, so I don't like car companies, and I don't like companies in China. I own Baba. Baba produces tremendous cash flow, fundamentals look great, and the stock doesn't go anywhere. And it's like, what the heck? These guys look really good, but I don't like car companies. Too much competition. It's hard to make money. Yeah, they're growing right now, but the car business is just tough. Tesla kind of throws everything out of whack because Tesla is kind of like a very popular stock. And it makes everybody else think, well, if Tesla's worth 4 or 5 or 600 billion, right? How much is Tesla worth? So Tesla's worth 660 billion. So maybe this one's worth half as much. Well, we can't use that logic because they're in China. There's just a big discount you have to take because it's a Chinese company. Second, it's in automotive. So I can't get through step one of my process to buy that company. So I would be a complete pass for me. Even if they are clearly priced at a discount, I don't know if the stock's going to rally. It may have short-term rallies, but over the last 5 years, it's up 500%. Awesome. I think a lot of the gains were back here. So BYDDY. And what I would say is, like, some investments are outside of my lane. Like, I don't reach out, like these high growth companies, whoever made the investment way back here, congratulations, you're doing well. But you could see that, starting in 21, there's not a lot of return. So the whole China companies get discounted is in play. Baba, BYD, other Chinese companies, they just don't have the valuations like US companies like Amazon, Meta, and Microsoft. Those things just keep going up and to the right. And in a way, they deserve it because they're really good companies. This one, the fundamentals look great, but I'm out on step one. I'm out. That's my comment on that one. All right. So we're going to talk a little Oxy. Let me catch up on comments. What do you think of the federal judgment against Google? So it won't affect your stock. Microsoft had antitrust issues way back when, if you recall. The government acts really slow. It'll be 5-10 years before they say you have to do this or that. In the meantime, Google will understand what the government doesn't like about their operation. And the reality is Google got to number one and dominant because they're really good. Their technology was the best. And they didn't get there by doing illegal things in the marketplace. They're just deemed to be a monopoly and they have too much control. So the government wants to make sure they don't do things that are illegal. So I don't think it's going to affect their stock price in the next 5-10 years. But I do think that Google is very well positioned for the AI business, as well as their other businesses are just doing great. Their search business is doing great. YouTube's doing awesome. Their cloud business is doing phenomenally. So I keep buying their shares. Michael Anthony, which days do you talk about stocks? So tomorrow we have a conference call. If you want to be on it, email me your email, and I'll put my email kind of in a way so that bots will not get it. So it's Victor H Investing at Gmail. So email me there and say, hey, my name is so and so. Please add me to the list. We talk tomorrow where we just talk through things, and good things come up. So if you want to join, let me know. Right. So let's get to Oxy. So oil companies have been really discounted, and Oxy is Warren Buffett's oil company. He also owns Chevron, and Oxy it does more exploration of oil, and when oil prices are up, man, Oxy does great. You can see that it did awesome coming out of the lows of 2020, and it really shot up. Warren Buffett looked like a genius. But oil companies have not been doing much. I own Chevron. I own a lot of it, and the returns have been terrible. They pay a nice dividend, but the returns are terrible. This one pays a little bit lower dividend. And with oil prices where they're at, there isn't going to be any short-term relief. It's just going to continue to be tough on oil companies. Now oil prices are really low. So oil is $68. Not too long ago, it was like clearly in the 80s. July, 2 months ago, was in the 80s, and now it's 68. Man. And when it goes down that much, it's just taking away cash flow and profitability from oil companies. So it's going to be tough, but you can buy Occidental or another oil company at a discount. You can see their revenues going down. Let's take a look at the quarterly. Although their most recent quarter, the revenue did go up, but this is concerning. Why is their revenue down for 5 consecutive quarters? Yeah, I'd want to know what happened here and understand if this is going to be sustainable to grow. With oil prices being lower, I'd be surprised if they didn't have a loss of revenue in Q3 that they're going to report. From a free cash flow perspective, these guys do. See, their cash flow is kind of all over the place. They had a high of $12.3 billion. That's when they had that stock price just really take off. I'd have to guess they're like a $5-6 billion revenue or cash flow company. It's an oil company, so multiply that times 10. It values at about 50 billion. Yeah, that's where it's priced, 50 billion. So it's fairly priced. Fairly priced. So if oil shoots up, this stock will go up. If oil stays where it's at, it's probably going to stay at this stock price. All right, the last one before we call it an evening. And I don't know if anybody's on Stonks, but Stonks users, if you guys want to ask a question, feel free to. Yeah, right now I think oil's like in a tough spot, man. Low oil prices. It's like, oh man, is oil going to go even lower? I don't think so, but it could. It'd be like, oh man. And if it had better discount, I'd probably be more interested in it. But if it's fairly priced, it's like, what's the best return I'm going to make? Is like 10, 20% in the next, year or 2 years. Well, that's not a very promising potential. So I'd have to pass on it. All right. CAAP. So airports. Now, this is an interesting idea. I haven't looked at an airport. So airport concessions. So they have like little retail at the airport. Okay. I bet they have pretty good margins because you're at an airport. PE travel's just been so high. They did go down. The revenue did go down. They kind of had some ups and downs. So why was Q4 so low? Yeah, this is kind of unusual for the revenue to drop that much. These quarters look really good, but this looks really bad. So I'd want to get an understanding of that. They're outside the US, so it's higher risk. Free cash flow has been good. It's on US dollars. Okay. So if it's, let's say, $100 million cash flow business. Oh, man. Yeah, I can't get to this valuation because I'd value it between $1 billion and $1.5 billion. That'd be the range. And I haven't even looked at their balance sheet, if their balance sheet's good. But yeah, I'd have to pass on this one. It doesn't have a lot of free cash flow. It's a retailer. They probably have to pay a lot of employees. It's an expensive business to run. So their total debt is $1.2 billion. And then their cash and short-term equivalents, $584. So that's not bad. They have like $600 million in debt, and their EBITDA is right about the same amount. So they could pay off debt in 1 year using EBITDA. So their balance sheet looks good, but there's just not a lot of upside here. I'm not seeing like this thing can go up or down. It's been going up nicely. Look at that chart. Now, what it's done in the past is it's not a guarantee that it's going to keep doing that, right? So it's nice that it's done that. Very good. Congratulations to the investors that went into it. It is a small cap, right? Yeah, 2.4. Yeah. But I'd have to pass on it. I'm looking for quality. I'm looking for a doubling over the next 5 years. This one is there's just too many things that are not very familiar to me outside the country. I don't really like retail. They had that really bad quarter. What happened there? That's a big question mark. So if you're interested, check it out. But I would not be more interested at this point. All right. So till the end, Oxy has good valuations, but still not sure. Depending on that much, single metric oil price is not the best. Depending that much on a single metric oil is not the best. I mean, you're right. If you diversify in another way, right? If you have an oil company, but then you have other stocks, like 10 others that do something else that's not pegged to the oil price, then you have diversified and you can control that risk. But good point. All right, guys. So that was a good live stream. We went for an hour and a half. I really appreciate you guys attending. And I'll try to do this on Saturdays. Again, Saturdays will be about learning and kind of hopefully getting some questions out there from investors that want to, elevate their game, become a better investor. And we can look at a few stocks as well. But everybody have a good night. And I'll talk to you on the next one. See you guys.